Hey everyone, welcome back to Actual Investing. Today I want to talk about two little hidden gem tech stocks that are both beaten down pretty significantly after their earnings. The first is Pure Storage, which is down almost 20% in the past 5 days. And the second is Elastic, which is down over 30% in the last 5 days. Both of these stocks are not very well known, but they're both very interesting tech stocks that I think merit a closer look. So let's dive in and see what's going on with these two stocks. Let's start with Pure Storage. So Pure Storage is a data storage company, and they sell both data storage hardware and services, something known as storage as a service. Pure Storage's primary hardware product is called a flash array. And essentially what this is a group of flash storage hardware devices all bunched together so that they can hold a lot of data. And essentially what Pure Storage is saying is that flash storage is going to be much more cost effective and more energy efficient than traditional data storage methods. When we think about the difference between Pure Storage's flash storage versus traditional SSD or solid state drives, flash storage tends to be a lot faster. It gets its name from being a lightning fast storage medium. When we get down to price, flash storage devices are going to be a lot smaller and less complex and are going to be a lot cheaper to use. Pure Storage boasts that their platform leads to 77% reductions in operating costs and 85% energy savings. When we think about AI applications and large accelerated computing workloads, these types of things often require a lot of energy to run. And there are even people who believe we're going to see an electricity shortage because of all this AI demand. I think that that's going to be a great tailwind for Pure Storage, which can help save on energy while still delivering data storage services that are fast and reliable. And as I mentioned, aside from just the data storage hardware that they sell, they also offer storage as a service through their Evergreen One platform. This is a subscription platform that customers will pay monthly or annually for, and it's a great source of recurring revenue. So if you don't want to host your own data center or have your own servers on site, you can use Pure Storage's servers and just pay for what you need as you go along. It allows companies to eliminate the risk and the hassle, honestly, of hardware ownership. So Pure Storage, quite an interesting business model where they offer storage as a service, or they will sell you the flash storage arrays if you want to have your own storage on site. Let's get into financials here because Pure Storage, I believe, has been executing quite well. When we look at Pure Storage, the first thing that stands out is that while they do have double-digit year-over-year revenue growth, it's certainly not anything to write home about. 11% year-over-year revenue growth is not bad by any means, but for a tech stock that you would anticipate seeing a lot of demand from AI applications, you would expect that to be a bit higher. So the problem here is that Pure Storage is really only seeing all their growth in their subscription platform, that storage as a service that I talked about, as well as other services that they offer. Their subscription revenue grew 24% year over year, so clearly that's carrying the company's revenues, while their hardware, not so much. Pure Storage notes that their annual recurring revenue, which grew 24% year over year, was driven mostly by their Evergreen One service offering that we talked about. They also mention that a growth driver for them are cost-sensitive workloads that are moving to all flash. Like we talked about, flash is cheaper and fast and less complex, so customers that are a bit more cost sensitive are going to be moving to solutions like Pure Storage. Pure Storage boasts that their products are never obsolete. Sure, I'm assuming everybody would like to think that they take less labor to operate and have a lower total cost of ownership while being more reliable than competitors. Pure Storage competitors tend to be companies like HP, Dell, and NetApp. Pure Storage claims to have over 100 plus AI customers, so clearly they are an AI stock, but I believe that pretty much every tech company has been pivoting into AI recently, so I'd take that with a grain of salt. When we look at total revenue for the year, we can see that product revenue actually declined from about $1.8 billion to $1.6 billion, where subscription services revenue handily picked up the difference, growing from $961 million to $1.2 billion. Obviously, these graphs are not to scale because this green bar should be much larger in this graph than this one, so I'm not sure who put this together, but that's a bit misleading. One thing that I really love about Pure Storage is their really strong gross margins. Typically, when we think about computer hardware companies, we are met with low gross margins. Think companies like Supermicro Computer that have gross margins in the low teens, or companies like Dell that have gross margins around 20%. Pure Storage has gross margins of 70% plus. That is quite strong, especially for a company that derives about half of its revenue from hardware. Obviously, the software gross profit is going to be a bit higher, but when we look at this orange line at the bottom, product gross margin is almost just as high as subscription gross profit. So clearly, Pure Storage has a superior product that customers are willing to pay a premium for. If they can have 72% gross margins on hardware, they're doing something right. And in case you're unaware of what gross margin entails, essentially this means that if Pure Storage sells a flash storage product for, let's say, $100, then they only paid about $30 for that flash storage product. So clearly they have the potential to be very profitable. And in fact, they are, with 16% operating margins. That means that after all their operating expenses are paid, they still have 16% left over. And since cash is king, let's look quickly at cash flows. What we can see is that they do have positive free cash flows, so that's great. We love to see that. Cash gives the company options. And while we're talking about cash, a quick note on their balance sheet. Pure Storage has almost $2 billion in cash, which is actually up year over year by about 48%. So clearly this company has no worries of running out of cash anytime soon. They do have quite a strong balance sheet, with their current cash balance being able to almost entirely pay off their total liabilities. And finally, when we look at guidance for the full year, this is fiscal 2025, which equates to about calendar year 2024. They're expecting about 11% revenue growth for the year. So again, nothing to write home about, but certainly not bad at all, especially for a company that makes half of their revenue from hardware. So Pure Storage on the surface looks really solid. They have double-digit revenue growth. They have a diversified revenue stream where half comes from services and half comes from hardware. They operate in an area of technology that I believe is only going to grow, data storage. As big data continues to become more and more pervasive in our lives, we're going to need a place to store all that data, and companies are going to be looking to build out their own data centers with Pure Storage's products, or if they don't want to build out their own data centers, they're going to use Pure Storage's storage as a service offering. So whichever way companies decide to go, Pure Storage can sell to them. So I believe they have quite a large addressable market. At the end of the video, we will look at Pure Storage on my spreadsheet and see how they score and see what I think of the stock. But before we get to that, let's talk about the next company, Elastic. Elastic recently reported earnings and the stock was down 28% on the day and then continued its slide the following day. So like I said, over the past 5 days, Elastic down 31%, essentially wiping out their entire gains for the year. Ouch. When we zoom out to a 5-year basis, Elastic is down 17.5%. So we're seeing some massive underperformance versus the market. But what's going on here and why is Elastic down and is it worth buying today? So first we need to know what Elastic does. Elastic is a big data search company. So essentially they are a competitor to maybe a Datadog or a Snowflake, where you can use Elastic's service to search through your data and make sense of it, something that's known as observability. Elastic's search AI platform can search a data lake, which is just a collection of a lot of data. It can ingest it, visualize it, and automate it and help companies make decisions about their data. That's something that's going to be hugely important because just having the data is not enough. You need to know what the data means, and the data has to be useful for your business. Of course, like I said, every tech company these days is pivoting into generative AI, but Elastic claims that they are generative AI optimized, and they allow flexibility to deploy their product however you'd like. Run our platform and solutions however you like, or leave the operational overhead to us and concentrate on getting your answers faster. That's what Elastic says. Elastic is also a key player in security, information, and event management, something known as SIEM, and this is useful for things like threat detection, compliance, and security incident management. This is something that is going to be relevant to essentially any big company. So again, like Pure Storage, Elastic is looking at a pretty big addressable market should they be able to capitalize on it. Speaking of which, let's go to their most recent earnings because that's what sent the stock down. And I think to understand why the stock was down so much, it's important to look at their guidance cut. So 3 months ago, they offered financial outlook for the full fiscal year where they expected total revenue of, let's call this about $1.47 billion. Just the other day, they updated this financial guidance to $1.44 billion. So they cut their annual guidance. That's not usually a good look. Oftentimes the market likes when companies underpromise and overdeliver. In this case, Elastic did the opposite. They overpromised and are on track to underdeliver. But as the contrarian investor I am, when I see a big dip like this, I like to take a look into the financials and see if I think the market is overreacting and see if there's an opportunity to pick up cheap shares. So we see that Elastic still growing strongly double digits. Again, it's not quite as robust growth as we're seeing from other SaaS firms, but it's still double digits and quite strong double digits at 18%. We see that this is driven mostly by their Elastic Cloud revenue, which has grown 30% year over year and makes up about half of their total revenue. So this is the star of their show, Elastic Cloud. In looking at other important SaaS metrics, SaaS simply stands for software as a service, one thing to look at is the number of large customers that a SaaS company has. For Elastic, they measure this by customers who are spending over $100,000 a year ACV, or average contract value. The number of large customers they have has been growing steadily over time and is uninterrupted. They continue to add more and more large customers, which are going to help them grow and be more stable. Great. Another important SaaS metric to look at is going to be their net retention rate, or net revenue retention. They call this net expansion rate, and it sits at 112% as of this most recent quarter. What this means is that their customers are spending 12% more on their platform this year than they were last year. So this is a metric that shows how well Elastic is able to upsell and cross-sell their solutions to their current customers. Anything above 100 is pretty much considered baseline. So if your net retention rate is below 100%, that means your customers are spending less with you year over year, and that's not a good look. So 112%, it's not amazingly high, but it's good that this is well above 100. And like we saw, they did cut their guidance, so they're looking at only 14% year over year revenue growth versus the 18% that they reported this quarter. So it looks like we're to expect a slowdown in growth later in the quarter. I'm curious if perhaps Elastic is being a bit cautious because the economy still has not recovered and small to medium businesses are still being quite tight with their budgets lately. But even if they do meet this guidance, 14% year-over-year revenue growth is not awful. So let's take a look at both of these stocks on my spreadsheet and see what I think of them. So this is my growth stock spreadsheet where I analyze growth stocks and rate them on 4 factors, which are gross margins, annualized revenues, price to annualized sales, which measures valuation without looking at profits, and year-over-year revenue growth. I aggregate the score of each of these to give a total score out of a possible 20. I've never seen anything close to 20. The average on my spreadsheet is about 12. So Pure Storage gets 12.4. This puts Pure Storage on the higher end of stocks that I analyze. What's helping them out is that their valuation is not terribly high for a tech stock at just 5 times price to annualized sales, especially given their strong gross margins of 71%. If we were to look at earnings, we would see that Pure Storage does have quite a high PE. However, we need to look at this like a growth stock and expect that those earnings are going to grow later in the future. Right now, they're focused on revenue growth or capturing market share, but as that revenue growth slows down, they should shift their business to looking at earnings growth. So I don't think PE is a very fair metric for Pure Storage. So even though it looks high, I think Pure Storage is still quite reasonably valued. Let's move on now to Elastic. Elastic gets a score of 12.2, very, very similar to Pure Storage. What's helping them out is, again, that strong double-digit revenue growth and a very similar valuation at 5.4 times annualized sales, very similar margins of 74%. So to me, these two companies look quite similar when you look at just these 4 factors. They both have over $1 billion in annualized revenue. They both have gross margins in the 70s. They both have a price to annualized sales of about 5, and they're both growing at double digits, though Elastic is growing more rapidly. So both of these companies I like. I actually did just recently buy one of them. And if you are a YouTube member of my channel, it costs $1.99 a month. You can see all my trades, and I posted the trade of the company I did buy on my community page. So definitely check that out if you are a member. And if not, just know that I do like both of these stocks, and they are both on my watch list at this moment. Even the one I didn't buy, I am still bullish on and may look to open a position in the near future. I hope that this video helped to introduce you to some stocks that you might not have been aware of before. If you have any stocks you'd like me to cover, please leave them down in the comments below. And if you liked this video, please hit the like button to help out the almighty YouTube algorithm. Thanks so much for watching the video, and I hope you have an amazing day.